Trying to imagine what you look like without one on.
Hi, Paula. Hi, Lazaro.
Is Alan on, Lori?
I have not seen him. No.
Anyone else we're expecting? Mayor?
I didn't hear from anybody indicating they weren't going to be able to participate.
Okay. Well, we'll give him one more minute. Okay, Lori, you think we should start? Yes.
Sure.
Okay, we're just waiting for Alan. We haven't heard from him. Okay.
I did send him an email just now
Yeah.
asking him, but we'll see.
Okay. Okay. Good morning. The meeting will come to order. Welcome to the virtual January 25th, 2021 regular meeting of the West Hartford Pension Board. My name is Nancy Dean and I am chair of the board. Because in-person attendance at public meetings is likely to increase the risk of transmission of COVID-19, this meeting is being conducted in accordance with Governor Lamont's Executive Order Number 7B, which permits municipalities to conduct public meetings virtually. Members of the board and some town staff are participating by WebEx, and members of the public can view the meeting live on West Hartford Community Television or on West Hartford Community Interactive Comcast Channel 5 and Frontier TV channel 6098, or at www.whctv.org. The meeting is also being recorded for on-demand viewing, which will be available on the town's website. Because of the virtual format, there are some special rules and procedures that I need to cover before I begin. First, I will ask all participants to please mute your devices when you are not speaking. If you wish to be recognized, please raise your hand, and I will call on you in the order I see hands go up. If you are participating via audio only, or I do not call on you and the debate is ending, then please unmute your phone and let me know so that I may recognize you. Second, main motions will be made by me and no second is necessary. We will proceed immediately to debate. These include motions to adopt, receive, or approve business items. Subsidiary motions still require a second. These include motions to amend. A member must be recognized before making a subsidiary motion, but any member can second a motion by just unmuting their line and saying second. Third, pursuant to Executive Order 7B, all speakers must state their name and title each time they speak. Fourth, because of the difficulty in tallying office votes on a video conference, I will require that all votes be taken by roll. And fifth, a reminder that if any participant has a problem with their connection, you should immediately call Lori Carney. She will let me know and we will recess the meeting while the problem is resolved. If it cannot be resolved quickly, we will ask you to call into the meeting using a phone and participate via audio only. I will now ask Lori to call the roll for us. Lori?
Okay. Nancy Dean,
Here.
Lazaro Guzman,
Here.
Al Lebo,
Here.
Ethan Goldman,
Here.
Brittany Birmingham,
Here.
Peter Privatera,
Here,
Mayor Cantor, Matt Hart.
I'm here. I'm sorry. I don't know if I can read it. Sorry.
Oh, thanks, Sherry.
Town Manager Hart's going to join in a little bit.
Thank you. Chris Kashmar,
Here.
Rick Ledwith,
Here.
Lee Gold,
Here.
Paula Kanaki.
Here.
Jennifer Evans is recording. I'm Lori Carney, present. Okay, Nancy.
Thank you. Thank goodness Lori is present since she coordinates all of this for us. So thank you, Lori. And thank you all for attending today. We did have a meeting not so long ago to go over some of the background information and begin to really do and then continue our due diligence on the investment side of the pension obligation bonds. But this morning we do have, in addition to continued work on that effort, we also have some of our regular business that we like to tend to. And in that regard, I have shifted our agenda from what our typical format is, or our typical order of sequence, so that we make sure that we cover all of those things before we enter into discussion relative to the investment component. So with that, I would ask Brittany, is there any report from the town employee side?
Nope, no reports.
All quiet? Okay, that's very good. Rick?
Morning, everyone. On page 4A, we have the remaining meeting schedule for the rest of the year. Our next meeting is on February 22nd, followed by May 10th. And I think the chair was going to discuss the possibility of adding a meeting or two.
Right. I think, I don't think we're at a position yet to specify any dates, but in anticipation of the funding for the pension obligation bonds occurring right around June 30th, I thought that we might need at least one, if not two more meetings in that June or July timeframe, since we typically have a gap in our schedule there. So just be aware of that as we get a little closer, or certainly by our February meeting, we'll have a better handle on that future timeline, that we will be calling a meeting or two in that June, July timeframe. Thank you. Thank you, Rick.
You're welcome.
We then have the minutes of both November 16th and January 15th. We should, I think, Lori, do we need a separate motion for each minutes?
Well, since I've listed them separately, let's
do that. Okay. All right. These minutes were included in your package, so you have had time to review them. So I will make a motion to approve the minutes of November 16th, 2020. Do I have, is there any questions or comments relative before we take a vote? No? All right. All those in favor, please say aye. Lori, do you need to go through your? Okay.
right. I'll have to do the
Yep.
vote one by one. Nancy Dean,
Yes.
Lazaro Guzman,
Yes.
Al Lebo,
Aye.
Ethan Goldman,
I wasn't here, so I'll abstain. I wasn't on the board.
fine. Brittany Birmingham,
Yes.
and Peter Privatera.
Yes.
Okay.
Motion carried.
Good. Thank you. I will then make a motion for the approval of the minutes of January 15th, 2021. All those in favor, I will ask Lori now to take a roll.
Okay, Nancy,
Aye.
Lazaro Guzman,
Aye.
Al Lebo,
Aye.
Ethan Goldman,
Aye.
Brittany Birmingham,
Aye.
and Peter Privatera.
Aye.
Okay, motion carried.
Okay. Thank you. Pension administration matters. Rick, is there anything of unusual note that you want to bring to our attention in this package of information?
Yep, the administration portion of the agenda is fairly routine this month with our standard new members and non-vested withdrawals and terminations. The only non-routine item is the additional retirement credit at the bottom of section 5B2, where a member purchased additional service credit but was not able to utilize that in their calculation. Therefore, the pension plan refunds that credit back to the member. We get about 2 or 3 of these a year. There's also 2 Read and Riga bills at the end of the packet for services rendered on behalf of plan participants.
Mhm.
We'd ask you to approve those as well, and we'd be happy to answer any questions that the board had.
Okay. I will first make a motion to approve pension administration. Any questions or discussion for Rick for clarification?
Yeah, I was just curious about, this is Al Lebo, member of the board. I was just curious about the legal expenses.
Al, we're doing the vote on the pension administration. We have to do the votes one at a time.
Okay, I thought that was part of it. My mistake.
Nope. It will be.
Can I ask a
It is
question?
there, Alan. It's just we need to we have to do the votes one at a time. One for pension administration and one for the invoices. I'm sorry. Yes. Did someone else have something?
Yes, Brittany Birmingham member. I'm just curious about the additional retirement credit. So does that member get back exactly what they put in, or is there any formula that that
Nope.
determines the amount that they get refunded?
They get the dollar amount that the additional credit that they put in, they get back.
Okay, so
Or
it's
is there interest on that?
No interest.
No interest.
okay. That was my question. Okay, thank you.
You're welcome.
Okay. Any other questions from the floor before I ask Lori to take a roll vote? No? Okay, Lori.
Okay. Nancy Dean,
Aye.
Lazaro Guzman,
Aye.
Al Lebo,
I
Ethan Goldman,
So couldn't get off mute fast enough. I'm sorry. This is on the names of the people on the letter, just because this is the first time for me, so I know what I'm voting on. Is that correct?
There is a section called pension administration, so there's probably 5 or 6 items for either gaining admission to the plan or terminations or different kinds of applications.
But It's the individuals that was listed.
Yes.
Okay, affirmative. Fine, I just want to make sure. Thank you.
Brittany Birmingham,
Aye.
Peter Privatera,
Yes. Aye.
motion carries.
Good, thank you. And there are 2 invoices to Reed and Riga, counsel to the pension plan that Rick has already mentioned. I would make a motion to approve those invoices for payment, but I will open it up now to questions. I think, Al, you had a question?
Yeah, thank you. Yeah, I just wanted to make certain, these are services for questions that were rendered by pension plan members in which we needed to give a response from a lawyer. Is that what this is about?
Yes, Al, that is accurate. And Laurie, you could provide the detail and
Sure.
those queries.
Are you referring specifically to the October 31st invoice, Ellen?
Yeah, yes.
Right, so we had questions regarding the ability to participate in the town pension plan for someone who is eligible for the MERS pension, so that there were specific questions there. Also a Part D participant and a quadro, questions that in regards to that we sought legal counsel on.
Okay, thank you.
Sure.
You're okay? I know in the past, we have always liked to make sure that the expenses are associated directly either with an employee or a participant's request or clarification of plan elements to specific things. So, okay. All right, then are there any other questions for Lori or for Rick? No, all right, then I will make a motion to approve the invoices under consideration for pension administration services by Reed and Riga.
Okay. Nancy Dean,
Aye.
Lazaro Guzman,
Aye.
Al Lebo,
Aye.
Ethan Goldman,
Yes.
Brittany Birmingham,
Aye.
and Peter Privatera.
Yes.
Motion carries.
Okay, good. All right, thank you. Very good. All right. Now I will look to Peter to give us an update of things happening here from his perspective. Thanks, Peter.
Good morning, Pete Privatera, Finance Director. Well, we've tried to answer everyone's questions related to POBs. I've sent out some more information. Tomorrow night, there's a public hearing, and then the town council will take action on the bond authorization ordinance and the reserve fund ordinance. If it's approved, then we will start the process to bring the bonds to market and sell the bonds. That process is going to take a little while because first we have to go to the state of Connecticut with some material that's required by state law and answer any questions they have. That's probably going to take about 30 days to get through that process. So shortly thereafter, I'm confident that we'll be able to answer all their questions. Shortly after that process, we'll start the process of selling the bonds and hopefully sell them at a great rate, close the first week of July, and then we'll have to talk about how we're going to invest them. So that's where we are right now. Thank you. Nancy, I think you're muted.
I was, sorry about that. Thank you, Peter, I would say. Are there any other questions for Peter directly before we look towards Chris to begin our investment discussion this morning? Alan? Oh, Alan, now you're muted. Oh.
Thank you.
Yeah.
Al Lebo, board member. Nancy, just to be certain, is this Is this our only chance to ask questions concerning the pension obligation bonds?
Oh, no, certainly not. I just know that we want to get focused in on to the investment side, but if you have a question specifically at this point, please feel free.
That's all right. We can go ahead with the rest as long as there's an opportunity to ask questions about the pension obligation bonds later.
Well, if you have a question, why don't you ask it now?
Okay. So first of all, Peter, I very much appreciate the materials that you sent out and the information you provided. In particular, there were a few illustrations of how this plan will perform under a specific deterministic scenario, and I appreciate that. There was also one scenario which was what I assume was the worst scenario that came out of the 10,000. Is that correct?
Pete Privatera, Finance Director. Yes, Al, that was one of the worst. That fell into the top 5 worst category, top 5% worst category. So that was one of the worst.
Okay, thank you. So what I didn't see here though was a scenario which I would sort of characterize as a worst plausible deterministic scenario, which would be like a 50% drop in equity values immediately after we're fully invested, and then recovery like 8% per year. Is that something we're still expecting to see?
At this point, I wasn't planning on any more analysis. A 50% drop in equities, that would be pretty severe. I did have a conversation with Chris Cashmere, our investment advisor, just to get a feel for 1-year worst case, 3-year worst case, 5-year worst case, 10-year worst case on average. And we have had years where it's gone down in 1 year about 25%, and then we've had years when it's gone up about the same amount. But what we've discovered over at least the 10-year average, the worst case scenario, we would survive the worst case scenario based on the level of reserve fund that we have. And the best case scenario obviously would only increase that level of reserve. I mean, you can look at it from 20 different perspectives, Alan, and I'm just saying that, we could prepare a scenario with 10 years of single high digit negative growth and, blow the whole plan apart. But I guess the point I was trying to make in my cover email was, what's the possibility of having 5 consecutive years of negative growth, high single digit or double digit negative growth, without the federal government stepping in with some sort of economic intervention? That would pretty much destroy the economy. I mean, is it possible? I mean, anything is possible. We could have 5 years of high single digit growth on the asset side ourselves. So I think what we're trying to say is, here's a good example of a bad year. And in this bad year, yes, we've had 5 consecutive years in one section, 3 or 4 consecutive years of another section of negative growth. That could happen, but what's the possibility of that happening without any intervention from the feds? That's all the point I was trying to make. And I think the mayor she wants to comment on this, Nancy.
Oh, I'm sorry, I couldn't see. Yes, Ms. Mayor.
Yeah, so I also think that what the scenarios didn't take into account, and if we don't do the pension obligation bonds, is what happens in those scenarios with the ADEC payment annually, and would the council be able to make those payments? And I don't think that's the case, right? If we do see 10, 12, $15 million increases, I think the council might not be able to meet that obligation, and then it would ripple and make the scenarios worse. You're saying, okay, if the council rides all of those increases at 1, 2, 3, 4, 5, 10, 12, $15 million increases in an ADEC payment, then, you know, though that scenario would do better in 3% of the cases or whatever, that's not reality, because I don't think if the economy is bad, and the council would be in a position necessarily to meet that ADEC payment. So again, I think that's one thing to think about in our thought process and making this happen.
Yeah, and I just wanted to add one other thing. Right now our discount rate is 6.99%. So if we had 3 or 4 or 5 years of negative growth or very minimal growth, and we didn't hit that 6.99%, then that would just, exponentially increase our unfunded actuarial accrued liability moving forward, because we are amortizing that over the next 25 years. So, just to answer your question, Al, yeah, that was a bad scenario. Are there worse? Yes. Are there better? Yes. But can it be managed? I think it can. So I hope I answered your question.
Yeah. So my concern here is what we're talking about here is a leveraged investment. What we're going to do is we're going to borrow a whole bunch of money, and we're going to put that money at risk. And as the mayor just said, we're having trouble, funding the ADEC without having that additional amount of funds. So, I just want to make sure that if we go ahead and do this, we understand, how bad could this get, and how could this be tweaked to avoid the worst situation. Maybe we need to dollar cost average for a longer period of time or something like that. And the way to understand that is to take a look at what realistically could happen. Now, in the past 20 years, we've seen the market drop 50% twice. We saw it drop 50% between 2000 and 2002. We saw it drop 50% between 2007 and 2009. So that's certainly something that could reasonably happen. And the issue here is what happens immediately after we're invested. This worst case scenario that was presented actually showed a market increase of 50% over the first 5 years, followed by a decline of 35% in the next 5 years. And again, it's the critical, it's right after we're invested that is going to make this, work or not work. And that's why I'm really interested to see, what would be the situation if we had a big loss immediately after we were invested, even if we then fully recovered thereafter. I really think that would help inform, what's the best way to invest these funds once the bonds have been sold.
Al, I think that that's a discussion. Those are multiple discussions that the pension board's going to have to talk about. I mean, the option that Chris came up with was a 6-quarter gradual investment. I mean, if the pension board feels that there needs to be more conservatism attached to that, maybe 8 quarters, then certainly it's up to the pension board to make that determination. Once the bonds are sold and the funds are put into the trust, it's up to this board to determine what's the best and probably the most conservative, asset allocation moving forward, at least in the short term.
All right. Well, in order to make that decision, there are 2 things that I would like to see. One is this sort of 50% drop scenario, and the other is I'd actually ask that we commission a different set of 10,000 scenarios using a more robust and more realistic scenario generator to take a look at what might happen. So when it comes to actually making some of these investment decisions, I really think we need to have some more information.
Can I just add one more point? I mean, looking back at the 2001, 2008, and then, today, when the dynamic today, which is hopefully unique, but maybe not. We have had a 6.6 return with our current portfolio mix. And so we've seen a real life example of what happens. We also have seen a real life example of what's happened to our payments over that period of time. $5 million in, well, $2 million in 2001. And now we're paying $27 million. So I think those are very important factors to look at, what we've experienced in the past, and those numbers that have come out of that in real life, and then going forward, what we expect from that.
Yeah, Nancy,
Yes.
I think the point that Becky was trying to make in her analysis was that, that many years of consecutive loss plays havoc with depletion on the reserve fund. Okay, and she said that basically it's that consecutive years of that high level loss that pretty much depleted the reserve fund before the end of the term. So the point I was trying to make in my cover was, what's the possibility of that happening? Not necessarily a 1 year significant drop, because we've had both drops in growth, but a sustained drain on the reserve fund for that long period of time, and that was a concern. And that's why the comment I made was, well, what's the possibility of that happening without any economic stimulus or government intervention? But if the board decides that when the bonds are sold and the funds are deposited in the trust, if the board decides that they want more modeling or a more conservative allocation, that's the board's determination at that point.
This is Nancy Dean speaking, Chair. Pete, if we did want to do additional modeling a little further down the road, what sort of process is that for Becky? It's not sort of a full, she doesn't have to like recreate the wheel to do that, right? Because her data sets and the components of the plan are all within their modeling capability now, right?
Yes, I mean, we can, I mean, if we can actually tell her, we can give her asset growth rates to plug in if we wanted to, and say, okay, let's just take this model, but let's change the first year into a 50% asset loss and then let it ripple through the model. Mm-hmm. I think we can do that, and that's not, that would not be a problem for her to do.
Okay. So at this point, maybe, Alan, are you thinking that as we get closer, assuming that the process itself through the town council and the town itself gets approved, that at that point we still have some time to work through some modeling? I think the conceptual approach that Chris will be talking about, which is to do the investment of the proceeds of the pension obligation bonds over 6 quarters is very thoughtful and careful. Perhaps we may want to look at lengthening that out or doing some other kinds of step process with that. But I'm wondering if we might want to wait until we get through the fact that the town, everything, in that time frame, I guess, where what Pete referenced, that will be in that waiting period with the state, is that, and then we can consider some more detailed scenarios to request from Becky. I just want to be careful that we're thinking through what our request to her might be and not keep going back and back and back, so that we're being efficient with her time and our time. Would that be an approach you'd be comfortable with?
Yeah, Nancy, so you said that, we have some time, and that's actually what I'm most worried about, is I don't know that we do have a lot of time. I think, and to be clear, as far as, running a new scenario, the scenario that I'm talking about, the scenario in their model is a 3 by 25 set of numbers. That's all it is. And you just, plop it in the model and it runs through. This is not anything difficult for them to do. And so it seems to me that there are a set of deterministic scenarios that we could give them. They could run it in about 10 minutes. And it would be informative to us to see, you know, what does that mean when you run that through the model? What does it look like? And then there's some what if questions. Well, you know, if that creates a situation that the town couldn't sustain, you know, what if we then, you know, use a 8-quarter, you know, dollar cost averaging period instead of 6. And it would be good to have some time to take a look at those what ifs. The other thing that I mentioned a second ago is, you know, what they did as far as 10,000 scenarios is really, you know, as they said themselves, is incredibly simplistic and does not give a robust idea of what might happen. And I would recommend that, you know, we hire or that we purchase scenarios from a company that does economic scenarios in the format that Milliman needs, and plug those scenarios in and see how that works. And again, I don't think that that's anything that's terribly difficult or expensive, but something that does take some time to do.
Well, unless I will speak, Alan, unless I missed something, I don't remember your ever recommending that before, but I may have not heard that. But I think before we would consider what your second suggestion is going to an additional outside source for some scenario building or variable testing. I'm not quite sure. I'm not an actuary, so I don't know if I'm using the words correctly. But I think I would need to have a little bit more formal information so that we could make sure that everyone on the board understands the costs associated with it and what kind of process we'd have to use for that. Can you provide that to us in time for our next meeting, or in between now and the next meeting?
Yeah, I could provide that in between.
And Peter, is there, when we are looking to services to provide to the pension plan, do we have to have a multiple review process, or would this just be hiring an expert for a certain type of thing, so we'd have the latitude to do that?
I mean, normally if we're hiring a separate organization, we get some quotes on it. I don't know who out there. I'm sure there are people out there, and I know that, you know, about 7 or 8 years ago, we hired a firm through FIA, subcontracted through FIA, to do a 30-year projection for us, and they came back with with 10,000 different scenarios. And and Chris, you know, correct me if I'm wrong, I think at that point they came back at about 6.2 for the next 30 years or something. So, I mean, we can do that. You know, if the board feels that there's value in that, then I'll expedite it. I'll, you know, whatever we need to hire someone. But, you know, I don't know, you know, I don't know how long it will take.
Well, I don't know how long it would take either. Alan seems to imply, if I can, but I will ask, this is Nancy Dean speaking, sorry. Alan, if you want to send a summary of what you're saying now with some specifics regarding who it is that you're recommending, what you think the cost is, what the turnaround time is, that kind of thing. You could certainly send that to me, and we will circulate it amongst the pension board members.
Okay, thank you.
Okay. Laz?
Yeah, Nancy, Lazaro Guzman, pension board member. You know, I think from one of the things, and Alan brings up a good point in terms of looking at what would happen, you know, in the early years. I think timing makes a difference when you're withdrawing large funds. You know, maybe another suggestion might be, you know, I think here if I'm correct, we have 4 pages, different scenarios, and there were 10,000 simulations. So maybe there were other scenarios where what we're thinking about actually happened in one of those 10,000. So thinking is maybe it's just worth bringing in the actuary just to talk a little bit more about the modeling. And then also before we bring them in, have some ideas in terms of what specific things might we like to see that maybe were already part of the 10,000 scenarios. Like for me, you know, it's the period 2007 to 2009, if we were to invest all the, you know, the proceeds from the POPs, and then right after that, we had something happen like 2007 to 2009, what would that look like? Because that has happened, certainly very possible. So just out of curiosity, you know, how would that look here? So, you know, I'm not sure that, I think at this point, I just have more questions about the modeling in general.
This is Nancy. Did I hear you say you have more questions about the modeling? Is that what you said?
Yeah, just because. Yeah, the number of scenarios. So if I'm correct, they sent out, I think, four different scenarios that are, I think, you know, what they're considering kind of to be the worst case in what Peter sent out.
Can I just qualify that, Lazaro? It's Pete Privatera. Two of those scenarios were requested by Ethan Goldman, the 6 and 5.5. And I thought they had a lot of merit because you can see that even at those lower rates, we still showed, excuse me, a positive balance at the end of the 25-year payment. And the other one, Al had asked for a worst case scenario, and we just threw in our current scenario as kind of a guide. So it wasn't, you know, those were specific scenarios. I just wanted to clarify that. Thank you.
Yeah, no, as I look at it now, so we've got a scenario that's kind of the bottom 5%. But I think my point is that in the 10,000 simulations that they ran, we may already have some scenarios where right out of the gate we have, you know, 2007 to 2009 like returns. So before we make a decision to go and hire a third party, maybe it's just worth getting, you know, talking to the actuary and kind of getting some more clarity around among these bottom 5%, you know, were there scenarios that were very similar to 2007 to 2009, and how did those look?
Yeah,
and if not, maybe we model specifically, you know, the returns from 2007 to in the last however many years, again, just to kind of give us some comfort. If we had a repeat of 2007 to 2009, how would that look? Because maybe there's something in there already. I have to think that in 10,000 scenarios, there's a lot here that, you know, that we're just not seeing, because we obviously have very good or specific scenarios, but there's a lot of scenarios there that may have been considered already.
This is Nancy Dean speaking. I'm wondering, in the interest of the group's level of comfort, I think what we're wrestling with the dark side, which we all know too well can happen. If it would make sense to have a call with Becky, Peter, in between now and our next meeting. I know you have a million things to do, getting ready for the whole project, but this is, this is very weighty decisions from the investment perspective for the board as a group. And I think it may be beneficial to, as a first step, maybe have Becky come or speak with us just on this particular topic. And then we'll assess that kind of follow through of, with Alan's recommendation, do we need to go to another step to sort of peel the layer back? Would we be able to get Becky to come in the next 2 weeks, say, or within 2 weeks?
Pete Privatera, Finance Director. Yes, that would be no problem whatsoever. And we can have her model the 25-year period in any manner we want. And I agree with Lazaro. I think in that 10,000, there's got to be a handful of scenarios that mirror, you know, the time period that he was talking about.
Yeah, this is Nancy. I would think so as well. I think though we just want to make sure we, if there are, at this point, it's all on their data sets that they've been running, and I want to make sure if there is a feeling that there needs to be yet another look at from a different lens. I think that may be what Alan is suggesting, that we have the opportunity and the time frame to do that. So the first step would be to have Becky to come in, or not come in, but visit with us in another meeting. So. Unless I hear, I will say now that I will make a motion that we do, I don't know if it needs to be a motion, but that we will ask Becky to prepare with direction from Peter, but that for an open discussion with the pension board within the next, I don't know, I don't want to put a time frame on it, but do I hear any concerns about taking that as a next step from those participating this morning, the members of the board?
I don't have any objection to having Becky come in and talk to us. Just in answer to Laz's question, I did have an opportunity to discuss the scenario generation with Becky and another actuary on her team. And I also had proposed that 2007 to 2009 period as well, modeling that out as well. That's something that's very easy to do. That's one of the deterministic scenarios that I'm suggesting. We certainly could put together 25 deterministic scenarios and just say, run these. And it seems to me that that's absolutely no issue for them to do whatsoever. And I would suggest we do that. As far as the idea of running 10,000 different scenarios, we can have Becky come in. I'm sure she'll bring the person who did the economic scenario generation with her. But what we're going to hear is that what they did was extraordinarily simplistic. They would say that themselves. That all they did was they took a normal distribution and said, randomly, markets go up and down, and came up with some answers. And that does not give you the breadth of results and the the distributions that really allow you to understand. And it's not calibrated against the markets as well, so it doesn't give you a good idea of how this actually would play out. It just it just gives you some scenarios to sort of focus on and take a look at. Well, what happens in this one? What happens in that one? And I think that's what we'll hear from them if we bring them in.
Nancy, can I make
Yes.
We're going to have maybe 5 months until, if everything moves forward, we'll have about 5 months until the board has to make a determination as to what to do with the money, how it should be invested. So I do think we have time to run different scenarios, look at different options, extend the gradual investment period. We can look at it. We can, if this board wants to hire another actuary to look at it, we can do whatever the board makes a determination as. I think in that 10,000 scenarios, there's a lot of good scenarios. There's a lot of bad scenarios, and if it's a simplistic approach, the point is no one knows what's going to happen over the next 25 years, but we need to be prepared. So, I can have a conversation with Becky if there's specific scenarios that the board is requesting that we run. Provide them to me, and I will give them to her. I will have her run the scenarios, and then at our next meeting or special meeting, she can come in and talk about the impact of those scenarios. We certainly can look at it from as many angles as we want. And I know Chris is waving his hand, so I'll stop.
Chris?
Through you, Madam Chairwoman. Good morning, everyone. Just quickly to the points that Alan and Lazaro and I think the mayor made as well. So we've gone back through the 20-year history, the data that we've got ready access to, right? The period ending 2020 December, and had run through with Peter a variety of different scenarios with the actual data. Not modeled, but what actually happened. So this group is quick to the punch, of course. The worst rolling 3-year period in those 20 years that we've had coincides with the quarter ending in the first quarter of March 2009. And the annualized number on that rolling 3-year period was minus 8.8%. That encapsulates, as you can all imagine, calendar year 2008 when the plan was down 27.5%. And then if you looked at, and the mayor had already mentioned the 6.6% annualized number, of course, that encapsulates some of these downdrafts. If you extend the rolling period on a 5-year basis, the worst rolling 5-year period for the plan in that 20-year history is minus 1.9%. And then the worst rolling 10-year period happens to be 3.8%. So, there are a variety of data points beyond that we could look at. And just as I wanted to offer that additional frame of reference to the board, just so you had it.
This is Nancy. Thank you. I think what I'm hearing is maybe I would propose we do a 2-step approach here. First, we will ask Becky to come back, or not come back, but come and discuss. Pete will give her some specific requests if you have specific things that you want addressed. I know, Alan, we did have a session that you were able to ask Becky and the members of her team some specific questions, and that we would do a similar type of meeting here. Maybe we will not keep it to a full-length meeting, but we will certainly allow for sufficient time for discussion. And then, as Peter said, as I said a little while ago, there is a time horizon here to work with, but we need to be methodical in our review. That we will ask her to come in within the next 2 weeks, and then subsequent to that, we will go to the next level, which might be what Alan has suggested in terms of I guess, an alternate view of how to run those scenarios. I do think there is a lot in those 10,000 scenarios that has already been run, but they may be too pure vanilla, or whatever way you'd want to characterize it. It may not be dynamic enough for everyone or scary enough for everyone. And this is a very formidable task that's ahead of us. So we need to take as many steps to give ourselves the confidence in what our mandate is here to manage those funds. So I would ask Pete to do that within the next 2 weeks. Is that a doable time frame for you, Peter?
Yes. I mean, certainly if there's any specific scenarios to run,
Yes.
I can ask you to run. But I think I think not everyone, but I think one point needs to be made as well. What's the impact of not doing this? Okay, in terms of we just don't do anything and just keep funding it the way we're funding it now. Every year, we're going to be looking at $1 million, $2 million increase a year over the next 25 years. So,
Yeah, I think my sense is that we're now focusing more on what to do when the funds get infused into the plan. My feeling is we are mentally focused now on a very formidable task for this board come June or July when the funding takes place. And that, so this is not one approach or a review to go back to that thought of the need or the decision. That is not our decision, the issuance of pension obligation bonds, but it is our responsibility for the investment of those funds. So I think that's what we're trying to do, is get educated on that. Lazaro, sorry, I recognize you.
No, I was going to echo that. At least for me, the additional modeling of certain scenarios is not to question whether or not we should do this. It's really just to have a better appreciation of kind of the risk of the worst case scenarios, and right. Then to your point, to Alan's point, does something out of that analysis that maybe we change the dollar cost average period, right. Something with how we invest it, but at least, and I don't want to speak for everybody else, but for myself, this isn't about, this isn't about going back on the decision. I think there's there's enough scenarios that show that the probability of this working is favorable and in the best interest of the town. So it's just, now that if we do this, let's do it the best way.
Right. Okay, Pete, that's where we are, I think.
All right. Thank you.
Okay, good. So we will ask, Rick's list of next meetings will get changed again because we will have we will have some more, but this is a very important time for what we have to do as well as for the town. So we will be asking some more of your time in that regard. Alan, before I get over to and Ethan and Brittany, any other questions at this point before we give the floor to Chris to go through all the enormous amount of material he sent to us?
Thank you, Nancy. No, I don't have any additional questions. I will try to put together some scenarios and some information about the proposal for a different 10,000 scenarios. And I would just echo what you said a moment ago that, from my perspective as a member of the board, the question of, should we fully fund the pension or not? Well, of course we should fully fund the pension. That would be wonderful. So that's not what I was questioning. What I'm questioning is when this money comes into the board, what do we do with it?
Right. Ethan, did you raise your hand?
Yeah, I just had a question, and maybe this isn't. I'm just trying to understand the process. One of the key inputs into the spreadsheet was the annual town contribution, and the town is paying the pension bonds, but it's also making a $9 to $10 million a year contribution to make the fully fund the pension. Is there any obligation on the town council to do that, or can they 5 years from now say we're just paying for the bonds? It was just a question to understand the process.
It's Pete Privatera. The town council is required to make those payments. We have to make.
Okay. Great. Thank you. Appreciate it. And thank you for the 2 simulations.
Okay. Brittany, you're all set? You're good? Great. Okay. All right, Chris. Time for you to join the meeting. Thank you very much, Peter. Thank you. Go ahead, Chris.
Well, good morning. Thank you, Madam Chairwoman, and great conversations this morning for sure. Do we want to, Lori, bring up the first of the 2 attachments on the screen? Do you want me to share and bring up on the screen the big report, and then we can segue over to the POB? Is that okay for everyone?
This morning, Lori.
I don't know if folks can see my screen right now and see the report, the cover page.
Sorry, I had muted. Yeah, please. Thanks, Chris.
Yeah, we
Everyone
can see it, Chris. We can see
Everyone can see it? Okay, great. Well, we'll, as the chair said, obviously, we're not going to be able to get through all these pages, nor that's our intent this morning, but we will hit a couple of the highlights, and I think we've already kind of talked at great length about what's going on, certainly behind the scenes here. The governance content this quarter happens coincidentally to center on asset allocation analysis. And for this group already, of course, you've seen a sneak preview of that at our prior meeting. And this is just a replication on page 14 here of the contemplated approach to the investment on a go-forward basis, so that the biggest takeaway here, I think, for the board to be reminded of, you do see the existing mix on the top line there, upper left-hand corner, right? The 65% at global equities, 5% in real estate, and then 30% in fixed income coincides with our inputs on a long-term outlook, a long-term basis, with a 6.3% annualized return. And I think, as everyone knows, right, the 6.25% has been the bogey and the basis for a lot of the analytical work's done. And I suppose this is our affirmation to the board that the existing allocation, again, using our long-term inputs, would support over the long haul achieving that 6.25% and a little bit beyond. We talked about a $6.25 cost averaging framework, right? And we'll obviously fine tune that and take further direction from the board. But we did want to acknowledge and recognize, obviously, on the front end that creates a hurdle, right? You're not going to earn a 6.3 or 6.25% when a big chunk of the collective assets are sitting in some type of a short-term vehicle that doesn't have the earnings power. We can come back to all this for sure, and I know we'll have lots of conversations around this. So that's I'm not intentionally running through this quickly, but it is a little bit of a repeat, and I know we'll do a lot more. So I just wanted to remind the group where we stand. Quickly, just in terms of markets and backdrop, before we look at the numbers for the portfolio. So it was right another quarter where kind of risk taking and risk appetite for investors was generally positive, and a very strong quarter, as you all know, in capital markets. And with events, no surprises, right, tethered to developments on the healthcare front, with notable upticks in markets and sentiment. When you heard, if you will, better news, more positive news about vaccinations and whatnot. So there continues to be a lot of appetite for risk, and certainly as I switch to page 17 here, a lot of numbers here. We won't go through all of them, but the precursor again, right, is what is driving beyond just developments on the healthcare front. Well, it's lots of stimulus and pledges to do more, right? And investors have taken that to heart. We have very low interest rates, as you all know, and that has driven appetite on a relative basis into equities. And you see the returns there again. We won't go through all of them, but the S&P up 12%. Small cap stocks up 31% in the fourth quarter, the biggest quarter in their history for that index. International stocks up pretty healthily as well. You see there 17% for the quarter alone. And then the bond markets kind of grinding away. Interest rates on the back end of the curve touched up a bit in the quarter, but appetite for spread remained strong, and the broad fixed income markets eked out a small positive return as a result. The other thing under the hood here, and you'll see it momentarily when we look at performance, you did see a broadening of the return patterns away from large cap U.S. equities, which had been so predominant for so long, as you all know. So when you looked under the hood in November and to an extent in December, international equities, small cap equities, value is a style, all kind of catching up over the truncated period and outperforming large cap U.S. equity. And that's encouraging to us, right? One, it's kind of an advocacy for true global diversification, which you folks have always adhered to, as frustrating as that's been until recently. And then moreover, oftentimes, it's certainly not a guarantee, but oftentimes those broadening return patterns have been associated with the advent of new economic regimes. And to the extent that you buy into the fact that at some point here, maybe in the back half of the year, efforts are made in terms of the efficiency of vaccination distribution. You've heard about the stimulus pledges, and certainly Chairwoman Yellen looks like they will be out of the gate pushing for more fiscal stimulus. Should that all come together, you could have the makings right in the back end of the year of kind of a new step up in global economic momentum, and that would certainly be helpful. I am going, in the interest of time here, and not run through all this in great detail. On page 18, there's some composite data economically. It hints it to what I just mentioned, that you do see some acceleration in some of the data economically, as draconian as some of the headlines can be. Some of the data has been surprisingly persistent and strong, and expectations for it to continue on a go-forward basis are evident in some of the GDP forecasts being put out. Again, and perhaps the back half of the year. We talked on 19 already of what's going on with the equity markets globally. The bottom half of the page teases a little bit what I just mentioned about those preferences for international and small cap and value being more predominant in the quarter. The upper left-hand corner is something of interest to us, right? Always be mindful of valuation. U.S. markets for a long time had been doing a lot better, and their valuations, no surprise, reflect that, right? So you see there that the U.S. markets, at least on certain metrics, posture more expensively than do their international counterparts. Really, no surprise to anyone on the board, and moreover, we've got healthy exposure to both, of course. So we should be able to take advantage of those situations as those markets start to coalesce a little bit the way they historically have. On page 20, quickly on upper left-hand corner, interest rates, you see there, if you can make it out, between the beginning of the fourth quarter and the end, that uptick in interest rates I just mentioned. Not dramatic, but certainly persistent from about 5 years out the curve. Interest rates did grind a touch higher. Although spreads in the very lower right-hand corner, as you see there, I mentioned just a moment ago, continue to be well behaved and continue to grind a little bit higher there. And certainly from where they stood back in the spring of this year, you'll see there, right, the big gap out in spreads, and then the kind of the repair there, if you will, in sentiment and appetite there continued through the end of the calendar year. So I think with that, I'm going to just pause for a minute. I do want to be sensitive to time. And before we look at the portfolio and a couple of data points, any questions on the economy or markets more broadly before we spend a minute or two here on the actual portfolio? No? Okay, hearing none, we'll forge ahead here. So here's the representation on page 24, the portfolio at the end of the calendar year. You see $254.4 million at the end of the year. That certainly feels better than the number you'll remember at the end of March, when the portfolio was valued at $193.5 million. And we, of course, came off that very difficult first quarter, and we'll see momentarily the portfolio did perform nicely in the subsequent 3 quarters. I suppose a pause here just quickly, what I think would be obvious to everyone, right? Given how well equities have done vis-a-vis fixed income, you do see we are a touch overweight equities, both domestically and internationally. By my math, to restore us back to the targets explicitly, the 70-30% mix you see in the target column, I think we'd need about $8 million transferred from domestic equities to fixed income to restore that allocation. So I guess a straw man proposal for the board, you can see there, Vanguard Total Stock Market Index in the middle of the page, the Peer Capital Small Cap Growth Portfolio a little bit further down in the exhibit, and the Vanguard International Growth Strategy at the very bottom of the exhibit or thereabouts are all a touch overweight, most notably overweight, I think would be natural sources to trim their overweights and put those money back to fixed income to restore the balance a little bit. So let me pause there for a minute, see if that notion resonates with the board or makes sense. But it would seem to us to be that discipline that we've talked about having in the past. Any questions from the board?
I was having trouble unmuting myself. This is Nancy, sorry. Yeah, is that, certainly, Chris, we have been fairly diligent in staying within close range of our target allocations. Are you proposing to make these changes sort of now, right? I mean, there's
I think I would think it would be a natural time to do it, right? We have had a strong run up in equities, as everyone knows. To lots of the conversation we've had this morning, we certainly don't know what's going to transpire over the next several months or quarters. And we've had a very strong run. January has continued to be fairly strong in equity markets, I think, as you all know. So in our minds, just the discipline of let's take advantage of that strength and do what thoughtful portfolio construction and allocation, right, demands or requires or maybe necessitates, trimming the winners and putting the money back to the laggards a little bit. Again, against that larger 70%, 30% mix that we've talked about strategically, the board has adopted and has been comfortable with.
Right. I would then make a motion that we follow your recommendation to execute those changes and bring the portfolio back to target allocation, but I would make that motion now and then open it up for discussion. Are there any questions or comments? For some reason, I can't see everybody on the screen, so.
I had a question. This is Ethan Goldman,
Good, thank you,
board
Ethan.
member. How often do you all look at the asset allocation? And is it something that, because I understand, and again, I'm trying to understand things as I go along. Is it something that gets looked at on a regular basis, or is it sort of locked?
A great question, Ethan. So we formally look at the asset allocation of the plan annually, at least annually. And that's why it happens this quarter, as you know, coincides with some of that analysis you've seen, which further coincides with the POB discussion. But to answer the question, we look at it at least annually and more frequently if market conditions warrant it. We're looking at the actual allocation itself, obviously, much more frequently in real time throughout the year, right? So at the very least, the board has, multiple occasions, and we kind of share that perspective on multiple occasions throughout the year as we're doing this morning. So it's a little bit of a two-tiered process, but
Right. Yeah, and I would chime in too. This is Nancy Dean speaking. We do have our investment policy statement, and we do affirm that on an annual basis. I think the last time that we did affirm it was May of 2020. And that I think that's in your materials, Ethan. So that also outlines out what our ranges are, as well as our determines the targets for asset categories. It may be an appropriate, as we're working through over the next 5 months, that would be a normal topic for us to come onto our agenda, but it certainly should be on our screen as we're looking at the infusion of all the new cash.
So we're going to look at this. I apologize if I'm not getting it. So like May, or is that the annual time frame that it gets looked at, or is there a formal date, or is it just ad hoc?
Actually, I think we have instituted, I think we probably look at it on a more regular basis. And if something were to get way out of whack, Chris would be pointing us or guiding us through that discussion on a on-time basis or a regular basis as we went through the year. In terms of a calendar requirement, I believe we do the review, is it, Chris, in the first quarter, the fiduciary, what I would look upon as the fiduciary oversight, is that Q1 or Q2? Is that when we normally do that?
I'm going to go right back, Nancy, because I don't want to miss out. You're right. We should have the calendar.
I looked at it too, yeah.
Oh, I'm sorry. I missed that.
Here is Ethan, to your question here, kind of how we work our way through the governance content, over and above the market. So is a fourth quarter, right, which is the kind of the quarter we're in now from a reporting perspective. We've got some of that capital market assumption work that we talked about and some of that summary asset allocation analysis. And then you see here how we kind of progress through the year. We'll look at fees next quarter and some training, if you will, in the second quarter, and then kind of on down through the list here.
So is that calendar? I'm sorry. Apologize, Chris. Ethan Goldman, I guess, board member. Is that calendar quarter or fiscal quarter?
So this is calendar quarter.
Okay, so you all did it in the last quarter.
So the asset allocation work that you see that we talked about this morning and encapsulates that the fourth quarter, correct?
Okay.
What we talked about on the capital market review front.
Okay.
Does that answer your question?
Yeah, if it was just looked at it, then I guess you should be falling into it. I just didn't know when that happened. Okay, thank you.
Okay. Then we have are there any other questions in terms of the motion that's on the, to follow Chris's proposal to reallocate to rebalance the portfolio, I should say.
Yeah, I had a question, Nancy, for any Birmingham member. Just as a more layperson's perspective, if we didn't do this reallocation, what would happen?
Yeah. So I'm Chris Cashmar, advisor. So Brittany, really, right? Nothing would happen. I think, as the chair said, you're well within your tolerances already, right? Per the investment policy statement. So it's not like we need to cure a deficit on that front. Really simply, equity markets could continue to go up dramatically, right? And this stance would be more favored than a rebalance stance, or they could go down, right? And this stance would be a kind of a deficit, right? Because you have more in risk assets than equities than the target calls for. So again, that's kind of a cute answer, I admit, but the discipline here and the takeaway is we want to adhere to our larger policy in our asset allocation strategy. And when you've had a particular component of the portfolio, equities do as well as they have, it naturally introduces, I think, a motivation to retrim and take some of the money off of the table of that winning hand and put it back to fixed income, which has lagged a little bit. All, again, centered right and knowing that earnings power of the 70-30 mix that we have today is kind of being a guidepost, right? I suppose. So, but nothing happens if you don't do it, right? Simply the portfolio would continue to do as it's done, and the markets would take us where they take us.
But I guess it would be riskier to not do anything, right? Because just with the chance of it going down, I guess, before trying to allocate it to a different class.
Yeah, I think your intuition's spot on, right? This portfolio is a touch riskier than the target policy that you've adopted by virtue of the fact that we've got more in the riskier asset classes than the statement, if you will, calls for. Not dramatic as we see here, but a little bit nonetheless.
Okay. Thank you.
Okay. It's also an exercise in our discipline this is Nancy Dean speaking, that, the reason for policies are to make sure that we have a stated discipline and that we force ourselves to revisit that every time.
Right. I agree.
Yeah. Okay, good. All right. Any other questions, Alan or Lazaro? For some reason, my little screen, I can't see everybody. So please speak up if you want to say anything more. No. All right. Having not heard that, Lori, I think I would like to take a vote on this if possible. So the vote would be for to accept and empower Chris to execute the plan as he outlined to rebalance the portfolio closer to our target.
Okay. Nancy?
Aye.
Lazaro?
Aye.
Alan?
Aye.
Ethan?
Yes.
Brittany?
Aye.
Peter?
Yes.
Okay.
Motion carries.
Great. Thank you all.
Nancy,
Yes.
at the top of your screen, do you see an arrow? Because that would allow you to see the other people. If you click on that.
Oh, I just clicked on something that made everybody go away. So
Oh,
I'll stop playing.
maybe we can.
I will turn things back over to Chris while I find what's happened here. Sorry.
Great. Thank you, Madam Chairwoman. Chris Cashmar again. So the other thing I would just, in 10 seconds time here, we do have the totality of the portfolio, the roster managers on maintain from a due diligence perspective. So we don't have any action items for the board to contemplate this morning. I think the lineup's in pretty good working order. And then finally, just so you have the data here, you do see I'd focus your attention down in the middle of the page, 2/3 of the way down. You'll see the elongated rectangle, the trailing performance summary. So you do see a good quarter for the plan, quarter up about 12.5%. fairly handily outpaced the benchmark. And who would have thought right back in March that we would be talking about a calendar year up double digits? And you see the plan in calendar year 2020 was up 16.6%. Versus 14.3% for the benchmark that we're using that's identified in the upper right-hand corner of the page. So the managers did a pretty good job navigating through the crisis that was 2020, which is encouraging. And there was breadth in those returns too. And then I'll stop here, I promise. But if you were to work your way through some of the numbers here, more recent numbers, you'll see contributions from fixed income and from domestic equity and from international equity. Bearings about holding serve down at the bottom of the page, if you will, a touch behind. I would tell you they've been fairly aggressive in terms of being cautious the way they're marking their portfolio in light of the pandemic, and probably more aggressive than many of their peers, which constitute the index. So I don't think there's anything problematic there necessarily, but just kind of a final point on the return front. And that's, Madam Chairwoman, all I had in terms of a portfolio update. I believe we had a charge as well, and I do want to be sensitive to time. We can always take this up again in February, given the ongoing discussions on the allocation front. I know there was a charge from the board relating to ways to increase the yield of the dollar cost average pool over of the original thought that we had was to confine the proceeds, you'll remember, to very short-term, plain vanilla fixed income. And I think there was an appetite to look further out the yield curve, if you will, for some higher yielding opportunities, perhaps alongside some of that. So that information was included in the packet. I don't know if it's the appetite this morning to go through that, or if the board would want to kind of take that up in alongside the ongoing conversations on asset allocation and investment analysis, I think that are coming in the next few meetings. So I'll take direction from board on that.
Right. This is Nancy speaking. I am very appreciative of all the work that you did in that regard. And certainly as we work our way through what the proper phase-in time of investing into the equity part of the market, or in total, and how we do with the proceeds that from the bond issuance. Knowing what to do with the sort of waiting cash is a very critical component for the board to deal with. But I am also respectful of time. But that being said, we can look at it in more depth in a subsequent meeting. But I don't want to pass anyone who might want to have a specific question for you this morning. So I open that up to the floor. And again, I can't see everybody. So if anybody wants, please click on. Thank you, Lazaro.
Thanks, Nancy. And thanks, Chris, for putting this together. So yeah, no, this is all very good. And so just in the interest of time, on page 24, where you show the returns, I think we left off some of the intermediate term bond funds. So just for the next meeting, we do go over it, I think, in more detail. If we could see those, so we can look at them all at the same time on page 24.
Yeah, if I could, Lazaro, I was going to mention Chris Cashmore again. Yeah, we did. We didn't have access to all the return data just yet, but we'll fill out the spreadsheet for you. We wanted to get you some of the detail on yield for those strategies and the like, but direction taken, and we'll make those edits for the next time.
Yeah, great, appreciate it. And then the other thing too is just the more that I thought about it, just kind of food for thought for the next meeting when we go into more detail. You know, as we think about going a little bit further out on the yield curve to something like with the duration between, I'll call it between 4 and 7. You know, I think the main objectives are, you know, from day one, not to give up so much spread in terms of we're paying around 3% on the POBs. Short term, we're going to get somewhere around, call it 0.5%. we were going to start at about a 2.5% deficit. So part of it was just to kind of reduce that deficit right after the gate. But then the more I thought about it too, in terms of, we think about our liabilities having a longer duration. And so, if interest rates did go up and kind of drove more of a negative return on the intermediate term bond side, just thinking in the context of assets and liabilities, I'm not sure, I guess it minimizes our interest rate risk to go out a little bit further on the yield curve just relative to short term, which isn't a bad thing either. Just kind of, having a little bit better match of assets with liabilities. So something to think about. Again, I think we can go over that about the next meeting.
Any other questions for Chris at this point? Thank you, Lazaro. No? All right. All right. Then I think we are, and Chris, thank you and your staff very much for all of this that you're going through here for us. This is a huge effort, and we, as you know, we all want to be very grounded as we make any of these decisions. So it's an important component to that strength for us. Any other matters of business that anyone would like to bring to the table this morning? Now I can see almost everybody, so I don't see anyone. All right, good. All right, then I will, Lori, anything else that I need to do? We're all done?
I think we're good.
We're good. Okay, then I will have a motion to adjourn the meeting. Thank you all very, very much for your attendance and participation. And Lori, we'll get back to you. We'll kind of work through Pete and Becky's availability and then get back so that we can have another call just to focus on that particular issue. So thank you very much. Have a good day, everyone.
Thank
Bye.
you.
Bye.